always, love to hear from Ramesh, and our viewers really appreciate his intellect. Ramesh, good morning. Thank you for joining us, and thank you for taking time out to be part of our anniversary celebrations.
Hey, Nikunj, Aisha, good morning to both of you, and of course, congratulations to you and your team. I think the Last Street is a Tower of Babel in many ways, lots of voices, and you both guys do a great job of separating the facts from the fairy tales. So, congratulations and keep doing that great job.
Ramesh, we are waiting in anticipation. When is it that we're going to get a birthday cake baked specially by you, delivered to our office?
I owe you that, Aisha. You're right. I promised that the last time. So the next time I come to your studio, I promise you I'll come laden with gifts.
You have to. We're going to hold you for it. We've been waiting since last Diwali for your cake.
But you're right. I do owe you guys that one.
Okay, great.
Okay. Ramesh.
You have been, and that's fair. It's on my conscience, Aisha.
I know.
Okay. And so, Ramesh, fact, fiction and fairy tale. The move this year actually has been nothing short of a fairy tale. It's been a vertical straight line for benchmark indices, 20% for the Nifty, 25% for the mid-cap index. So do you think this market now runs the risk of running ahead of itself?
Nikunj, is a question, of course, that a lot of us think a lot about almost every day. And to be completely candid, I have been a bit circumspect on the market. And the reason for the circumspection is not necessarily the domestic, where there's a lot of flows and valuations are still not extreme at my point of view. But because you remember the longest running bull market post the crisis started in America. And there is growing evidence that the American bull market, the bull is tired there. We might be entering the third and last phase of the bull market in America. Why do I say that? Because complacency is very high, volatility is very low. If you break up the S&P 500 into the 5 FANG stocks and the 495 other stocks in the S&P, the outperformance of the 5 stocks is extreme. By some measures, in the last 4 years, the FANG stocks are up 53% CAGR, while the S&P is up 5 or 6%. So typically in the third phase of a bull market, while the indices keep making new highs, it is masked by the fact that the undertone is fairly weak and only 4 or 5 stocks or of a handful of market leaders make a new stock. So the question then is that if the Dow starts entering bear territory, we're just guessing this, I'm not saying it's going into bear yet, then how do emerging markets behave? And remember, we come full circle. We started this bull market with quantitative easing by the Federal Reserve, and now on the last meeting they're saying they're going to shrink the QE program that they have in place. So I would still keep an eye out on what's happening in America. There is some evidence that there's some froth building in the Indian market, but the flow of domestic money is so strong means that even if the market wobbles, it tends to pick up after the next few days. So will we break when the Dow breaks? Yes. Can we recover from that? Probably.
How significant could be the quantum of this crack that you're talking about in the US markets be, Ramesh? And if indeed we see a 5 to 10% or even more than that fall coming in for the Dow, how isolated could we be? Could we also fall with that same quantum?
We always like to think that we are different and that we will survive this. I seriously doubt we survive this. Remember, interest rates have started inching up, and we probably have another interest rate rise coming in the balance 6 months of the year. So we have to watch. I mean, you have the 5 FANG stocks, Microsoft, Tesla, a few companies like that are really powering up and holding the S&P 500. The broader market is already starting to underperform in America. And you've had this bull market going for 7, 8 years. So now the bull market that went up on easing, quantitative easing, low interest rate, benign commodity prices, at the peak, we are having the lowest volatility that we witnessed almost in a generation. We are having the highest amount of complacency in the US market. It looks like a recipe that the market could be down more than 10%, say in the balance of the year. A lot of the people who follow the market more closer, like Mark Faber, Jim Rogers, are echoing similar unease about the valuations in the US market. So given the fact that interest rates are set to rise out there, given the fact that complacency is the highest, volatility is the lowest, it seems like almost a perfect setup for a crack in prices. Can we survive that? I don't think so in the short run. I don't think we are still linked with global flows, linked with sentiment in global markets. So in the first leg, if the Dow falls, we will also fall. After that, I think our own fundamentals look increasingly better. So we will pull away from that. But the first knee-jerk reaction in all global markets, if the US cracks, will probably be downwards.
Decoupling is all but utopia, doesn't quite exist in the real world. But Ramesh, you were just alluding to the fact that even in domestic markets, you are seeing pockets of froth actually building up. What makes you say that? And what are those pockets that you're talking about?
Actually, just look at the housing finance companies, for example. I mean, they're, it's a business that have very few moats to entry. And in fact, as the valuations are growing richer, a lot more people are coming into, entering these businesses. Almost everyone is doing well. These valuations will get stretched over a period of time. And as Nikunj and I have often talked in the past that, if you pay a high price, you almost assure poor returns in the future. So, when it's a momentum market, these tend to do well. I think most analysts on your television channel have argued that a lot of the mid-cap stocks, have seen their, share of froth building up in the, you've had, almost exponential moves in those stocks, almost without catching a breath. So, while the domestic flow, and especially if they come to Indian mutual funds, assures that money will get into the mid-cap stocks, because that's where the Indian public likes to invest in there. So we are seeing that, and that money flow is very, very healthy and very, very strong, and it's good. It's much needed in the equity market. Particularly, investors are feeling that there's no other choice out there. You want to invest in stocks, you can't invest in gold or real estate because of their poor performance. So that wall of liquidity is now supporting the prices. But if something changes in the dynamic, someone panics, someone pushes, an exit button, perhaps there will be some sort of mayhem there. So, it's always prudent to be careful. When, as Warren Buffett has said, when, people are greedy, we want to be fearful. And when people are fearful, we want to be greedy. And I think the odometer is moving towards the greedy side right now. So it's always prudent for good investors to keep an eye of caution.
Ramesh, so, you're calling for a top for the Dow, but if you have to really stretch that to India, at what age do you think this bull market is in? I mean, the US market is a tired bull market. The outlook is not sunny, the outlook is cloudy. But let's say if I talk about August 2013 as the low point or the beginning point for this bull market, what cycle are we in here?
Nikunj, the good news there for Indian investors is that we are still well within the second phase. And I actually believe that even if the Dow gets into bear territory, which will be a very sharp fall from here, India will be fairly resilient because domestic money is there, the Indian story of reform is on track. There'll be a different set of circumstances playing out. So we'll do fine. I'm not saying we'll do fine. The first knee-jerk reaction will be down. So you have to keep an eye on that. The US, could get into a bear market. It could. I'm not suggesting that we are there yet. But I think while we're not waving the red flag there, at least the yellow flag is more prominent out there. I think most savvy investors there are noticing the extreme divergence in stocks. The S&P 10 stocks, for example, are pulling away from the rest. The broader market is not supporting, the stock market rally anymore. So, it's, to belabor the point, it's time to be cautious there. And we know what happens when the Dow cracks. No matter what we say about the strength of a technology base,
Well, the strength of technology and rains in Mumbai, anything can happen.
That is what jinxed it, yeah.
Yeah. Ramesh, can you hear us? We've lost him? Oops. So don't go away. We'll try and fix that satellite connection. Bear with us. Blame it on Mumbai rains. When it rains, it pours in Mumbai. And I'm sure somewhere outside, these are just technical issues. Because it's rare to get Ramesh Damani on television. And I'm grateful and thankful that today he's accommodated our special interview request to join us on this special day. 24 points up meanwhile for the Nifty. For HDFC, it's about 4 points. Reliance Industries, buy on rumors and definitely sell on rumor and you sell on news. This could be called as a boring old market adage, but it just gels in perfectly every time when stocks, they go up in anticipation of a news, event, numbers, and then when the news comes out, some of these stocks, they fall. Arvind the Pharma, okay, Ramesh Damani is back. So Ramesh, we've got your thoughts on what your concern for the Dow is, because the cost of capital, like Buffett says, it acts like gravity. But I have a very simple follow-up question, Ramesh. If world is so worried about cost of capital moving up, why is the 10-year paper, and I'm talking about the long duration paper, 5-year and 10-year paper, at historic low?
The fact of the matter is that even as the Fed is raising interest rates, inflation is falling. I mean, they have guided inflation at 2% levels, but even when they raised the rates a few days back, the interest rates was setting low. So, that's why bonds are, coming off. I'm not sure I understand how this global economic jigsaw puzzle feeds up, but logic suggests, just pure logic of watching the market, internals, watching the market on a technical basis, suggests that the kind of breakaway moves that we're having in a lot of the FANG stocks, for example, Microsoft has gone from 3 years from $40 to $70. It's a large company, huge market cap. For it to almost double in value takes some serious firepower. So if you go after those stocks, the Alphabet, the Googles, the Netflix, the Teslas, Tesla was 200, year to date it's up 60%. This kind of moves, typically are associated with the final flurry. I'm not saying we are at the top yet of the Dow, but the gathering clouds suggest that, the Dow might be at risk. That's all the point I'm saying right now. That's the limited point I'm making, that the technicals of the market suggest that the Dow is at risk.
So, we've all known that some of your favorite themes in the market have been some of the domestic real estate plays. And by domestic, I mean more closer home, Mumbai, that is. We've also talked about logistics in the past. You've also talked about mid-cap IT as to how you feel that a disruption is going to play out there. Tell us, out of these themes, what is it that you're comfortable still holding into your portfolio? And where do you think, the time has come maybe to exit out and cash out?
Aisha, it's a good question, because we always ask ourselves this question, and Buffett framed the question very well, and I'll repeat it for your viewers. He said that if you could buy a stock and go away for 10 years and come back, what stock would you hold? And I think that's the question we're increasingly asking ourselves, because as you've noticed, whether it's in developed markets like America, there is increasing fear of automation and artificial intelligence taking over most of our basic day-to-day functions. I'll give you an example that was quoted in one of the magazines. It's more tongue-in-cheek. They said the factory of the future will have two people in it. There'll be a man and there will be a dog. The man will be there to feed the dog, and the dog will be there to make sure that the man doesn't touch the machinery. All right? So we're heading to an environment that a lot of industries that we know of today are going to become obsolete. For example, the most obvious example, driverless cars, electric cars moving on to driverless cars, automation on the factory floor. So in that environment where a lot of businesses are basically unstable, I think we're looking at the construction space. I think that is still a heady rollout that requires a lot of expertise of construction companies. We like quick service restaurants because we feel that India is still very underpenetrated, and that business is going to boom over the next few years. So those themes fairly isolated from the threat of technology, and areas where India is promising rapid investment and rapid growth for those two places. So other than the sectors I mentioned, I still like real estate companies in Delhi and Mumbai. We still like a lot of these technology companies in the mid-cap area that are antivirus servicing or with Aadhaar servicing. But among the new themes, Aisha, that have caught my attention, one would be, of course, this construction space. I think there will be soon in the next few years a capacity crunch among the construction companies. And if you look at the quick service restaurant, that's something that's really catching my eye because it's a B2C play and we are so underpenetrated, and it's so obvious the trends in terms of women working outside the house, lack of domestic help, increase of disposable income. You want a quiet, AC, organized place where to sit and eat your meal. So I think those trends will help that industry.
No,
I'm
Ramesh,
still stuck on just a man and a dog in a factory.
you think about it, what he's saying is that anything which is dull and dangerous will be taken over. A lot of your accounting job, a lot of your, things which are dull where even machines can take over will be taken over by a machine. And anything that is dangerous, I mean, anything which has got to do with drilling, energy, driving into the pits of mines and, digging out all the clay, mud and the ore, all that stuff has to be taken over. Dangerous and dull. I mean, these are two my words. Instead, I mean, Ramesh is talking man and a dog, but I would say dull and dangerous would be taken over. So Ramesh, we are staring at a world where disruption is real. We are staring at a world where artificial intelligence is taking over. But frankly, if you talk to investors here, they know that the world is changing, but they don't have options to invest in. And that's where, we want to lean on your expertise. Over the years, I've really appreciated the fact that you've really managed to, identify some of the mega trends. The Googles and the Amazons of the world, of the worlds are taking over the world. But frankly, as Indian investors, we are running out of options.
I mean, you're right. I mean, in terms of the investor database that you look at, for example, suppose you believe that there will be driverless cars that are electric in the next 10 to 12 years, all right? You have to rethink your position, obviously on the automobile industry, but on the auto ancillary industry, on the highway infrastructure industry, on the insurance industry. The number of drivers that are needed, it impacts so many industries. Auto is such an important component of GDP, and to actually think of a future without a man in a car driving, is to be pretty scared about the investments you're making today. So how do you play that? That's why there are very few businesses. I think food is a business that is fairly isolated. This country is blessed with a large population. We eat 3 meals a day, and how are we going to express that? Are we going to eat in? Are we going to eat out? What are we going to eat? Do we want value for money? The huge trend that I'm seeing, Nikunj, that you've asked me about, is this trend from unorganized to organized in India. I think if you've played that trend, the other trend is, say, from analog to digital. But with GST, this is going to get sharper. And as you play the trend from unorganized to organized, you will find that people in like quick service restaurants, where you go and have a snack at the corner store, people will increasingly want air conditioning comfort, they want good hygiene standards, they want Wi-Fi available, which perhaps won't be available at the roadside standards. Licensing won't be there, hygiene won't be there. So this is a great runway for that. There are only very few organized players in this, so they will command a leadership premium at some point in the marketplace. So particularly those who have a nationwide presence are rolling out, a quick value for meal budget. It's hard to imagine them not doing well in the next 3, 5, 10 years. So that's one way to play that. The other ways is that, for example, we're all worried about, say a virus attacking us, or say something to do with Aadhaar and the efficiencies that bring in. So companies in the mid-cap tech space that seem to address these specific problems should do well. They haven't done well so far. But my bet is that over time, investors will appreciate the opportunity size and the scalability of the businesses they offer. Or again, real estate and construction. I mean, India is woefully unprepared for housing, for infrastructure, in terms of stadiums we have in the major cities, in terms of roads. So that business seems to have a lot of headroom as far as I'm concerned. If you see what China is doing recently, they announced the OBOR project, One Belt, One Roadway project, massive infrastructure project across Asia. At some point, countries like India, China, which are not India and Japan, which are not a part of this OBOR, will link up and also develop the infrastructure. So there are very few companies in India with, Larsen being the large big cap, which again I'm not recommending, I'm just pointing out. But in the mid-cap space, there are half a dozen companies with a huge amount of technical skill sets that will be sharply in demand over the next 3 years. So maybe look that. But there is time to be caution. I mean, clearly, the idea that you could buy any of these companies and they will all do well, you would be worried about the coming technological revolution that is taking place before our eyes. I mean, so you're right, you have to be worried, and there are not that many ways to express an opinion on that.
Always a pleasure and a delight to have you on ET Now, and thank you for your insights, and thank you for your lovely wishes.
Thank you, Nikunj. Thank you, Aisha, and happy birthday.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.